Today, folks, another day to celebrate all-time highs. I kind of get tired of saying it almost. It's crazy the S&P continues to truck higher, still trailing the Canadian markets by quite a few percentage points if you tap on the juicy dividend that Canada offers here. And that is what we're talking about today, because I know you love those dividends as we break down the best performing sectors, the stocks I love within those sectors as we finish up the first half of the year. It is incredible to see with commodities pumping so damn hard, taking the Canadian markets to unparalleled highs. We need to talk about it, but of course I get exposure to almost all of it through my favorite monthly paying Canadian dividend ETF, VDI, which if you include the 4% yield, cut in half for the first 6 months. So we got 2% of that so far, and it currently is up almost 5%. We made 7% just off that ETF, which sounds pretty boring comparably to some of the individual stocks we own that have just been, propelling like crazy right now. But I'm mostly an index guy, and I'm hoping you are as well. So if you're on a path to financial independence, if you are a responsible investor and you want to join me on that journey, go hit that subscribe button, folks, because first and foremost, let's talk about the gold sector itself, because whether you're a junior explorer, finding new properties and building out resource estimates, or you're a really OG major miner, your values have just exploded this year. I mean, look at the VanEck Junior Gold Miner ETF, up 65% in the last year and 51% year to date. This is a sector where I wish I wasn't so dumb and I just bought into it, because it's not like some stock where you're speculating on the future. Like, gold is holding up, and for as long as gold is holding up, just hold these ETFs, because as the quarterly earnings come around, they're going to get exponentially better at these gold rates, because let's be real, you don't have to increase production when your prices are expanding by like how much? I mean, gold went from let's take a look at the 6 month here. I mean, even from 6 months ago, we went from 2,500 to 3,300. My God, guys, this is a disgusting increase on the price of gold. And you can get all exposure to basically the broad sector, not just Canadian gold stocks. They all sit in this ETF, especially the BMO Equal Weight Global Gold Index is up 72% in the last year. Year to date, 46%. Gold goes through these weird cyclicalities where it really doesn't do anything for like 5 to several years, and then out of nowhere just goes on some crazy historic run. I don't know if it's manipulated through governments. Obviously, gold is the largest asset ever by market cap, so it's incredible that it can run this substantially, even at the scale. I think it's over 20-30 trillion or something like that in total value. But yeah, if you're interested in the space, I'd love to hear your thoughts on it, especially if you played any of these. It is a bit of a regret of mine, and even still, I think it's a trade you could stay in, because until gold corrects, you really don't need to rush out of this, because we know every earnings coming forward is going to be way better than the year prior. So should be interesting to watch. Now, same with the energy market. I'll show you one stock that I really love. I hold it. It's a major holding in my Canadian portfolio because of the weighting it has in VDY. But oil didn't really stay up all that much, and people were really speculating on the back of the geopolitics in Iran, all these different Middle Eastern problems, that oil went parabolic for a bit, but man, didn't really stay up there that long. And now we're back down to this kind of modest level. But nonetheless, I still really like Canadian natural resources, which did spike a little bit on that geopolitical, unfortunate event, but has consolidated since. However, the reason I like this one so much is because the production this company has is disgusting. And regardless about how much, this is mainly a natural gas and oil producer, they're expanding their massive reserves. I think they have one of the largest natural gas reserves on the planet. And what you really want to look at is just the absolute jaw-dropping reality that not only as their earnings continue to increase on the back of decreasing oil prices, and it's not just oil, right? Like, oil might be coming down, but natural gas is actually staying up quite heavily this year. I'm surprised nat gas coming out of the winter season, which most people use for heating, usually see some cyclicality coming out of the winter, but this time it's actually holding up quite nice. But nonetheless, if you take a look at the production of this company, they're outpacing the drops in oil prices. If you look at the barrel equivalent production per day, guys, 1.58. Am I even saying that million? I mean, it's crazy, ththese numbers, from 1.3 million to 1.58 million in the equivalent production of barrels of oil equivalent per day. Same with like the natural gas. Look at the natural gas output here. Like, the expansion in these prices, even though oil is coming down, the fact that they're able to ramp up production so aggressively is kind of making up the difference in margin. And if oil goes back up and if natural gas stays up, this is a company that immediately starts printing ungodly amounts of money. And it's one that I never owned individually. I know some people that caught it pretty early on, and congrats to those people, because yeah, this became one of the best performing Canadian stocks kind of coming out of the oil crash. I couldn't imagine buying this when oil just went negative basically during 2020. I mean, the rate of return you would have got on this would have been disgusting, up 600% from the lows, plus the dividend. This is a dividend growth beast, going from 20 cents just 5 years ago to almost 60 cents. Like, it almost 3x'd its dividend in 5 years. Look at that, a 23.11% 5-year growth, annualized is just, it's stupid. The payout ratio is also very reasonable. Cash flow is very stable and up to the right. Again, you look at the statistics here. It's a company that's only paying out right now about 61% payout ratio. Every stat on this company is very reasonable. If you take a look at the balance sheet, even debt to asset ratio, 85 billion versus 45 billion in liabilities. I love that this is a massive weighted position, one of the largest Canadian companies, and also is, again, upper weighted in VDY. I wish I had the foresight to pay attention to this when like they started unlocking this huge value of oil and nat gas. But yeah, this is going to be a Canadian gem, I think, for quite some time. Enbridge, however, not as favorable, but again, it's not really a producer as much as it is the bloodlines to the Western world. I consider it more of a utility than an oil giant. And the only time this is really worth buying is when it dips materially, because it does go through a lot of cyclicality. And typically you can capture an 8 to 10% yield when this thing does drop materially. So I wouldn't buy it up here. It is also a large weighting in VDY, but on an individual basis, it's probably one of the best stocks you could swing trade. Most of your return just comes from the dividend. However, let's switch over to the banking sector real quick, and I want to explain to you why, when it comes to banks, I don't play them individually. And like Pokemon cards, you just got to collect them all, man. I mean, together they perform exceptionally well. Individually, they go through some cyclicalities, but up 7.71% this year. What is the HBNK currently yielding on that dividend? It's one of my favorite ETFs because it's relatively new. It's right around 4% right now. Again, another great ETF to cost average into on the dips. I also get all this exposure through Vidai, my wonderful VDY, and this thing's management fee is only 0.09%. Probably one of the best equal weight bank ETFs you could buy out there. But speaking of cyclicality, look at the performance in difference. I mean, Toronto Dominion is up almost 30% this year. My God, the performance is jaw-dropping. But you got to remember, the further you zoom out, the more this performance changes. Because on the 1 year, if we just zoom out to another 6 months prior, we can actually see the Canadian Imperial Bank is one of the superior performers, up almost 50%. I mean, it's up over 45, and next in line there is probably still Toronto Dominion. But if we zoom out even 5 years and go a little bit farther, then all of a sudden we see a really stark difference here, where BMO becomes one of the best performers in line with Canadian Imperial and Royal. This is why I'm saying you just kind of got to own them all as a basket, because the days of owning something like National Bank, this thing was a gem, a really small cap up and coming bank that just crushed it over the last 5 years, up 130%. However, because its market cap has scaled so dramatically, it's not going to be one of the better performers anymore, in my opinion. It's up 6.24% this year, still doing very well. But nonetheless, it's really hard now. You got to look at some smaller regional banks to maybe find that crazy upper weighted performance. But as a whole, there is no better banking sector out there in the world that has the same stability and performance that Canadian banks can offer. And if you wanted to own these Canadian banks and mix them in with maybe like a JP Morgan or get some US exposure, because the only better performing banks is in the US and the massive upper weighted ones. But still, I'm a little concerned about the performance of these ones specifically coming through the interest rate cut cycle, because obviously JP Morgan and the banks have been really relying on the back of higher interest rates to increase interest income, because a lot of banks sit on cash, our cash, and they like investing it, right? Especially when they can put it in treasuries and collect a 4 to 5% yield. That has been where this massive run up in JP Morgan has come from. And again, this is my concern with a lot of cash heavy sectors and finances, like the insurer players. So it's just something to pay attention to. But the banks are buy and hold forever like stocks. If we take a look at the utility space, the Canadian utility space isn't one of my favorites because there's not a lot of good Canadian utilities to own. You have Brookfield in there, you got Fortis, Hydro One, you've got Emera in here, which is actually doing quite well this year. Emera's up 14%, pretty good stock, but overall, when you zoom out, again, not the craziest performance compared to an index like the S&P or even a Canadian ETF. But if we take a look at the sector with Fortis, some of the other ones in the smaller caps in there, we're seeing a bit of a recovery. Northland Power, Algonquin this year, those are both outpacing. But the big giants that I like Hydro One, doing pretty well actually, up 9.98%, outpacing the indices. Actually, most of the sector is doing better than the broader indexes. But again, as we zoom out, that performance does tend to shift. This is a very stable sector just to collect some cash flow. But I told you guys, Hydro One is still the top of my list, one of my favorites. And on the 1 year has been the best performer of the bunch. If we take a look, however, and we bleed into the sectors that a lot of people loved but have been lagging dramatically for some reason. That has got to be the railways. Man, the performance recently in the last year, the railways has been very lackluster and a bit disappointing to say the least. And I'd love to get your take on why the railways have been so suppressed, because this was like a Buffett favorite. I know a lot of people leaned into this because the performance really did lead the Canadian sector for quite some time. But as of recently, I mean, Canadian National, especially over the last 5 years, has not offered that much of a return at all. So I'd love to get your guys' take on this. And I should point out as well, congrats to anybody that bought Power Corporation. I remember a lot of people a few years ago were saying this was a great buying opportunity. It is just primarily a financial services company that deals with wealth management. I think some insurance players out there as well, but does own Wealthsimple, which so many Canadians use today. And this thing is now up, just in the last little bit here. If you caught some of the lows in 2023, you could be up 50 to 100% there if you include the dividend. So congrats to anyone that caught this on some of that more suppressed cycle with Power Corporation. Again, remember, a lot of people recommending it. But yeah, the Canadian markets have just been 6 months crushing it on an absolute tear. I'm very thankful to have the Canadian exposure I have, but I need to buy a lot more of it. Feel still a bit underweight. I think Canadian exposure makes up somewhere between, it's probably just right around 15 to 20% of the entire exposure of our combined portfolios here. So I am looking to buy a bit more VDY and scale this over time as I take profit out of some of my tech companies, but that's still time to be said. I mean, we'll see how the markets pan out this year as I pass the question off to you. I'd love to know what you think about all of this in that comment section below.